Well, greetings everyone, and welcome to the Argonaut monthly video covering June 2025. Well, the main event of the month was the surprise attack by Israel and the USA on Iranian military and nuclear facilities. And although there were fears of escalation, a ceasefire was subsequently announced, which is so far held. The big beautiful bill also passed through the US Senate and is likely to receive presidential sign-off by the self-imposed July the 4th deadline. Focus will then inevitably move back to trade, with the July the 8th marking the end of the 90-day pause on reciprocal tariffs, and with July the 9th the deadline for negotiations with major trading partners. Now you can read our thoughts on this and the performance of the two Argonaut funds in June in our monthly commentary. Now we're now halfway through the year, and the first 6 months of the year has seen an almost unprecedented outperformance of European over US equities, some 16%, including foreign exchange. We're going to ask whether there's anything further to sustain this. And since we've talked about Europe and Eastern Europe in recent videos, we're now going to offer some views on the UK. We're also going to assess the performance of the daddy, aka President Trump, in his first 6 months and ask what it means for US exceptionalism.
They're not going to be fighting each other. They've had it. They've had a big fight, like two kids in a schoolyard. You know, they fight like hell. You can't stop them. Let them fight for about 2-3 minutes. Then it's easier to stop them.
And then Daddy has to sometimes use strong language to
You have to use
stop
strong
them.
language. Every once in a while you have to use.
So at the 2025 NATO summit in June, its members agreed to spend 5% of GDP on defence by 2035, including 3.5% on core defence requirements, with at least 20% spent on hardware and 1.5% on broader defence infrastructure. This policy is clearly a major achievement for Trump, though the more sceptical amongst us will see the announcement of the Sir Humphrey Appleby Yes Minister School of superficial policy delivery, obfuscation and delay, since neither Trump nor Putin is likely to be around in 2035, in 10 years' time. Now, President Trump's own finance bill includes $150 billion of additional defense spend, focusing on shipbuilding, missile defense and munitions, with the first $25 billion of funding for his Golden Dome missile defense system. And whilst for the past few years we've been very focused on European and in particular German defense investment opportunities, we are now finding investment opportunities amongst innovative US companies. I think there is some catch up there in terms of flows and perceptions. The daddy is also proving less isolationist than feared and much more effective geopolitically than his predecessor Biden or his alternative Harris would have been, with effective interventions in Iran, Israel and India and Pakistan. The tone on Russia has also firmed, and during the month Russia also continued to suffer setbacks in its conflict against Ukraine and in its ability of its economy to finance its war efforts. Now, President Trump's big beautiful bill attempts to repeal the heavily subsidized energy regime enjoyed by renewable companies under the Biden regime. Although lobbyists and vested interests have worked hard to avoid the total repeal of renewable subsidies, claiming bizarrely that it would increase electricity costs and would result in job losses in unsustainable businesses, the bill phases out subsidies from green energies that are not new, are intermittent and therefore have limited value to the grid, but still require taxpayer or consumer subsidy, despite at the same time bizarrely claiming to be the cheapest form of electricity. Now this will irritate net zero cranks and green grifters, but will cement the global energy and therefore economic dominance of the United States. It is also not difficult to see why Elon Musk is so upset. Not only will this bill remove the $7,500 subsidy for new EVs sold, but it will also eliminate the need for internal combustion engine manufacturers to purchase EV credits, which in recent times have accounted for over 100% of Tesla's quarterly profits. It will also remove the 30% investment tax credit for industrial battery storage systems and introduce strict requirements on the Chinese content of components, meaning that the company's energy division, which last year accounted for more than 100% of Tesla's growth, is likely to now go into reverse. Also on energy, OPEC is about to announce its fourth consecutive 411,000 barrels a day monthly increase in oil production, taking back 75% of the 2.2 million of cuts announced during the Biden presidency. Saudi Arabia cooperating with the US to bring down global energy prices is a diplomatic triumph for the Trump administration. This matters less for the US economy since it is energy self-sufficient, but is good, positive for global growth. Now, President Trump has again been rude about Fed Chairman Powell, criticizing him for always being late in cutting interest rates and refusing to cut interest rates in the Fed's 4 meetings in 2025 and delivering just 1/4 point rate cut in December 2024 under his second term, and by contrast, a 0.5 point cut in September and a 1/4 point cut in November, in his mind, for Biden just before the presidential election. Now, it's now Trump's stated intention to appoint a more dovish successor to Powell to take over as chairman when Powell's second term comes to an end in May 2026. But this successor is likely to be named earlier than May next year and could even potentially join the FOMC in January, creating a shadow chairman with consequently significant room for confusion in the market around communication on forward guidance. We also see the US Treasury under Bessent focusing on debt issuance on shorter term bills, and with bank regulation reducing risk weightings for domestic banks holding US government debt. So government policy is therefore attempting to lower the cost of capital for government borrowing. And this decrease in monetary independence at the Fed and the increase in refinancing risk for having so much of government debt on short duration should, everything else being equal, make dollar assets less attractive. But it's also likely that the Trump administration is at least unofficially very relaxed about the consequences of a weaker currency. Now, President Trump inherited an unprecedented 6 to 7% peacetime fiscal deficit, which few Democrats complained about until their man was no longer president. So the big beautiful bill has been criticized for not tackling the US fiscal deficit explicitly enough, and instead assuming that some restraint on public spending and relatively generosity on tax will be compensated by more robust economic growth and an increased tax take. So I think America's plan for its public finances, whilst imperfect, looks a lot more credible than most European countries. Put simply, in comparison with Europe, investors in the US can have a lot more certainty that the US economy will grow and therefore that the level of public debt is sustainable. And to illustrate this, we are going to compare the US to the UK. Now, the UK is currently projected to have a slightly smaller fiscal deficit to the US, 5% versus 6% of GDP, but with a similar level of overall government indebtedness, 99% in the UK versus 97% in the US. The problem is that public spending in the UK is now 45% of GDP versus just 24% at the federal level in the US and another 11% at the state level in the US. So let's say 45% versus 35%. But in the UK, the state now crowds out economic growth through too much regulation, too much tax, and subsidizing companies that wouldn't exist without government spending. and the state has gone from being 1/3 of the private sector to now just about the same size. So when government insists on taking from the productive sector and reallocating the resource that the productive sector could use to grow to the unproductive sector, often under the guise of fairness, you have a misallocation of resources, which ensures that the UK economy cannot grow. Now, UK pre-COVID public sector expenditure, including debt interest, was around 888 billion. It rose to 1.1 trillion in 2020 to 21, i.e. up 25% in just 1 year, and has never looked back. It has never now seemed to be under control. It's currently 1.3 trillion and is estimated to be 1.5 trillion by the end of the decade. That's plus 70% in a decade in nominal terms. Now, the inability of the nearly 1-year-old UK Labour government to pass even modest welfare reform during the month, with a rebellion of over 120 backbenchers, is just the latest sign of out of control public spending. Now, according to a recent research paper published during June by the Centre for Policy Studies, UK public spending will increase by 23% in real terms over the decade, whilst the economy is projected to grow by just 11%. And I know which of those figures is more likely. Of the increase in spending, an astonishing 39% is taken up by debt interest payments, 26% healthcare, 15% by welfare, with just 9% coming from increases in defence spending, leading its author to conclude that it has sometimes been said that Britain is becoming a health service with a nuclear deterrent attached. It would perhaps be more accurate to say that the state is becoming a combination of health service, benefit office and debt collection agency, with all other functions squeezed to compensate. If we are to avoid this, we need to fundamentally reconsider the role and reach of the state, while at the same time getting serious about radical pro-growth reforms. Now, what would be a catalyst to reverse UK economic decline? Well, we've spoken about the follies of net zero before, but let's also look at the politics. The latest Ipsos Mori UK opinion poll showed support for the Labour Party down to just 25%, with the Conservatives on just 15% and Nigel Farage's Reform Party on 34%. So what's astonishing about this is that support for the traditional parties, the uniparty if you like, is currently at an all-time low of 40%, meaning that Farage would seem to be destined to be Prime Minister by 2029. Now, whether Farage has the capabilities to govern successfully as well as campaign effectively is uncertain, but rather like when Javier Milei was elected president in Argentina in November 2023, Farage's popularity seems a result of acute disillusionment with the UK's political class, which seems unlikely to change over the remainder of the Parliament. Now, Farage as UK PM in 2029 is not 5% NATO defence spending by 2035, but is still too far away to be discounted by investors. Now, of course, the stock market is not the same, at least in the short term, as the economy. But nonsense London Stock Exchange ESG onerous reporting requirements, which often mean that 30 to 50 pages of annual reports are taken up by ESG reporting, and Maoist board diversity requirements are not conducive to a meritorious equity culture, whilst the UK government seems to be deluded that supersized low-cost funds are going to be bothered with investing in UK small and mid caps. So whilst the first 6 months of 2025 has seen a stunning outperformance of European over US equities, this seems to us to be more of a short-term catch-up trade with little to sustain it in the longer term. It seems unlikely to us that the period of US economic and stock market exceptionalism is over.